Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Just a quick reminder to like, subscribe, and follow the Finance Garage podcast on your favorite platform. Right now, we are on Apple Podcasts as well as Spotify. Furthermore, we are now hosting our podcasts on the SWU Group YouTube channel. Hey everyone, and welcome back to another episode of the Finance Garage. As always, I'm your host, Jonathan Wu, Senior Financial Advisor and Principal here at the SWU Group. And today we're wrapping up the August 2025 ASX earnings season. It's been a busy month when hundreds of Australian companies opened their books and gave us a peek into how they're faring. This season came at a pivotal moment for the markets. We've had high interest rates through the Reserve Bank has started cutting them. We've got inflation that seems to be easing but still simmering in the cost of living crisis, and consumers are under pressure but still spending in selective ways. It's a cocktail of factors, and companies have had to navigate rising costs, shifting consumer habits, and a changing economic outlook all at once. So what has that resulted in? A reporting season that's been full of surprises, some pleasant, some not, and some pretty wild stock market reactions. This is probably the key reason why I want to do an episode on this, is not so much talk about stock tips, as you know, because as financial advisors, we're not really in the market of being stockbrokers and getting clients to buy and sell individual securities, but it's what the valuations of the market as it currently stands are telling us today, and why we've seen some of these rather wild reactions from the market. Because we did see some solid profits met with share price slumps, and in other cases, what seemingly looked like a poor result actually prompted relief rallies. As one market watcher put it, it's all about expectations. Companies that merely met or slightly beat low expectations often saw their stocks jump. Today, we'll break down the key themes emerging from this earnings season, from consumer resilience and cost-cutting drives to a big focus on dividends and capital returns, and pockets of weakness in the healthcare and resources sector. We'll also highlight some standout winners among the tech and mid-cap stocks. So whether you're a seasoned investor or just tuning in to see how your Aussie stocks performed, let's begin and look at the August 2025 earnings wrap. Probably the biggest theme that's come out of it is how resilient the Australian consumer continues to be. Our shoppers and travellers are still spending. So despite higher interest rates pinching wallets earlier in the year, one key theme was that Australian consumers are proving more resilient than expected. In retail and travel, people kept spending on what matters to them, whether it be the essentials, a bit of shopping therapy, or a long-awaited holiday. Wesfarmers, who's the conglomerate behind Bunnings, Kmart, and more, reported that shoppers are beginning to loosen their wallets again. As inflation eases, Wesfarmers' profit for the financial year 25 was up modestly by 3.8% to $2.65 billion. But importantly, management noted an uptick in consumer confidence in recent months. Kmart's earnings jumped 9% as customers flocked to its low-cost product, and even Bunnings saw growth, with Aussies still spending on home improvement and DIY projects. It seems even with interest rates high, households found room in the budget for a new drill or even a Kmart homewares haul. Wesfarmers CEO Rob Scott said the trend of trading down to cheaper options actually helped Kmart and Bunnings. Quote unquote, households traded down to value but kept spending on home improvement and essentials. The company was confident enough to announce a hefty $1.7 billion capital return to shareholders, which was a special dividend or return of $1.50 per share, on top of raising its final dividend, rewarding investors for the solid year. We'll talk a little bit more about dividends in a bit. The shares of Wesfarmers were flat on the result day, likely because the good news was expected, but keep in mind the stock is actually up 28% year to date already, reflecting that investors had already anticipated a consumer rebound. And this is probably what is most important, is remember that the market doesn't trade on facts, it trades on expectations. So if stocks have been pricing upwards, it is also likely that they are priced to perfection. And if the results announcements are in line with what is expected, then you wouldn't expect the share price to suddenly rocket up, even if the result is good. Then we have something in the other direction, which was Woolworths. And it showed that not all consumer-facing businesses thrived in the last year. The supermarket giant's results revealed a more cautious consumer and some self-inflicted wounds. Woolies' profit fell about 19% to $1.39 billion as it sacrificed margins to cut prices and win back shoppers' trust amid a cost of living backlash. It turns out that after being accused of hiking prices, then touting discounts, Woolworths had to lower prices to repair its damage, and that dented the profit margin. If you look at some of the sectors, the Australian food EBIT, which is the earnings before interest and tax margin, slipped to 5.4%, which is down from 6.2% a year ago. Sales growth was also sluggish too, up just 2.1% in early FY 2026, which lagged far behind rival Coles, which had about 5% growth. CEO Brad Banducci, well, actually, Amanda Bardwell was quoted as the CEO of Woolworths Group's earnings, admitted the results were below expectations, and the market's verdict was swift. Woolworths shares plunged as much as 16% at one point, on track for their worst day ever. By midday of that announcement, the stock was still down around 13%, as investors were rattled by the weak outlook and even cut to the dividend. So the final dividend for the year was 45 cents versus 57 cents last year. It is again a stark reminder that in the groceries, price and trust do matter. And if a retailer blinks, customers will walk down the street to a competitor. Another interesting company and a household name was Qantas. Now, if you thought consumers were cautious after we talked about the Woolworths announcement, they were more than willing to splurge on travel. Qantas delivered one of its strongest results on record thanks to Australians' hunger for post-COVID travel. Qantas's underlying profit before tax soared 15% to $2.39 billion. Its statutory net profit was $1.6 billion, up 28%, and it even slightly beat market expectations. The airline cited ongoing strength in travel demand for both domestic and international flights. So think packed planes and people finally taking those overseas trips, which has flowed through to the bottom line. The low-cost arm, Jetstar, also had a standout year, carrying a record 16 million passengers. Qantas even felt confident enough to announce not just a regular dividend of 16.5 cents, but also a special dividend of 9.9 cents, which totals 26.4 total going to shareholders. And you know what? Investors loved it. Qantas's shares jumped about 12% on the day to around $12.47, hitting an all-time high of $12.52 intraday. It's not that often you see an airline stock at record highs. The optimism was bolstered by Qantas's upbeat outlook. They're forecasting solid revenue per seat growth next year and even ordered new planes to expand capacity. This is definitely a dramatic turnaround from just a couple of years ago when Qantas was navigating lockdowns and had something like 12 or 15 weeks of cash left. Now, strong travel demand and careful capacity management have it flying high, returning cash to investors. Of course, there is a little bit of clouds on the horizon, like that $90 million fine for illegal outsourcing, but for now the market is focused on the booming demand and cash flow. We then turn our eye to the consumer electronics, or I guess consumer discretionary, being Harvey Norman. And these consumers are still spending. We have to mention the furniture and electronics retailer as actually a surprise winner. Harvey Norman's profits actually skyrocketed 47% in the financial year 2025, helped by a rebound in its franchising and property income division. Sales also picked up towards year-end and into July, with nearly 10% growth starting in FY26, a very strong start. The company even hiked its dividend slightly, signaling confidence. What was the market's response? Harvey Norman's stock soared 13 to 15% on the results, hitting a record high of $7.09 and logging its biggest one-day jump since 2009. This is a stock that had been somewhat out of favor, but a much better than expected profit. So actual net income of $518 million versus the $474 million the street was talking about, and signs that shoppers are still buying big ticket items like furniture, turned it into one of the top 10 performers on the ASX that day. This is another example of consumer resilience. Even with interest rates that had clearly gone up post-COVID, people found money for home electronics and couches, perhaps thanks to low unemployment, and still okay household savings buffers. So in short, the consumer economy offered a few pleasant surprises. Discretionary retailers, like department stores and specialty shops, generally avoided the worst case scenario and even thrived by offering value like Kmart or unique profits. Consumers are spending, but carefully focusing on value and experiences. The next theme that I want to dig into is the theme of cost control and dividend focus at this year's earnings season, where we saw the boards of listed companies really play it safe. With inflation biting into margins and interest rates pushing up financing costs, many companies this season emphasized cost control and shareholder returns. It became clear that boards are laser focused on efficiency and on keeping investors sweet with dividends or buybacks, perhaps because growth was harder to come by. So let's unpack this a little bit. Across the board, cost discipline was a mantra. Companies that managed trim expenses or improved productivity stood out. For example, education services provider IDP Education had a tough year. Revenue was down 14% and profit was down over 50%, but it announced an aggressive $25 million cost-cutting program for the next year, nearly 80% more cuts than analysts expected. By slashing overhead and refocusing, even struggling firms signaled they're getting fit for a slower economy. IDP, though, wasn't alone. Plenty of CEOs talked about efficiencies and streamlining operations on their earnings calls. In fact, the biggest shock in cost cutting came from a giant, being CSL, a biotech heavyweight, said it will lay off around 3,000 staff, or about 15% of its workforce, and even spin off an entire division, being its vaccine business, to trim down and refocus. This in itself is a dramatic measure, showing how even the most successful companies are unafraid to wield the axe if it means protecting future profits. While cutting costs, companies also kept an eye on rewarding shareholders, perhaps to maintain confidence. This earnings season saw a flurry of dividends as well as capital returns. We already mentioned Wesfarmers' big $1.7 billion capital return and dividend hike. Similarly, we saw the Commonwealth Bank, which posted a record $10 billion profit, raised its full-year dividend to $4.85 per share, which is up 4% compared to last year. CBA is massively profitable thanks to early interest rate rises, widening its loan margins, and it didn't shy away from sharing the spoils. In the mining sector, BHP, despite a drop in revenue and profit, surprised investors with a better than expected dividend payout, which actually lifted its stock. BHP's underlying results, though, were soft on the back of global commodity prices having come off their highs, but the board's decision to maintain a high 50% payout ratio and deliver a strong dividend was taken as a sign of confidence. Any surprise is going to move the share market, one of the analysts had noted in their calls, and positive dividend surprises certainly did. On the flip side, if a company cut or missed on dividends, the market reaction was harsh. We saw that when we talked about Woolworths earlier, which pared back its dividend, contributing to the stock's worst plunge in years. Another example was Rio Tinto, which we'll discuss in the resources section, and Rio's half-year profit fell and it cut its dividend by 16%, disappointing investors and weighing on its share price. In 2025, investors have come to expect generous capital returns, especially after a bumper 22-23 period, so any stinginess is quickly punished. We also saw companies choosing share buybacks and special dividends as a way to return excess cash. For instance, in the financial services space, we saw Macquarie Group, although they're on a March year-end earlier in the year, had flagged buybacks with its earnings. And outside of reporting season, we got announcements like Telstra selling assets and proposing extra returns to shareholders, highlighting a broader trend. With growth uncertain, give the money back to the investors. This is a really shareholder-friendly stance that we saw across the market this year. The takeaway here is that in a mixed economy environment, companies are being prudent. They are very clear in cutting fat where they can and keeping shareholders on side with cash rewards. This points to a fairly cautious corporate mindset, where we'll save where possible and we'll reward loyalty to keep investors around. For retail investors, that has meant healthy dividends from many blue chip names, but one must also ask, are these one-off sugar hits? And are cost cuts coming at the expense of longer-term growth? But for now, though, the strategy has largely been cheered by the market, as evidenced by stable or rising stock prices when such measures were announced.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Now, a bit more on the negative side, we saw the healthcare and resources sector identify some weak spots because not every sector thrived this earnings season. These two are traditional stalwarts of the ASX, being healthcare and resources, turned out to be weak, but for their own reasons. If you start with healthcare, obviously we saw the CSL result, which I mentioned earlier, and that result, alongside its cost-cutting measures, saw a lot of its share price being wiped out. The stock actually fell from 270 to a new low of 230, wiping out billions in the market cap. It was a case of, well, you had a good past year, but what's next, being the market's focused. Even though CSL's FY25 profit was solid, it wasn't enough to overcome worries about the future. And the CSL episode, given the sheer size of the company, contributed to a broadly rough day on the ASX. And it underscored that healthcare stocks aren't immune to missteps. In this case, a combination of currency impacts, research and development costs, and perhaps an overambitious expansion that now needed reining in. We then had private hospital operator Ramsay Health Care also report, and it had a tough year, hit by a bunch of one-offs being extraordinary items. Ramsay's profit plunged 97%, basically collapsing to just $24 million after it wrote down hundreds of millions on its UK facilities which had underperformed. Even its underlying profit was only flat to slightly up, missing expectations. So to cope, Ramsay is focusing on cost outs and reshaping its portfolio. But the market reaction was unforgiving, and Ramsay's shares sank 12 to 14% on its results, falling into the low 30s. Investors saw not just the dismal FY25 result, but also guidance signaling further weakness ahead, meaning hospital volumes and earnings are not bouncing back strongly yet. Between higher staff wages, doctor shortages, and some lingering pandemic impacts, healthcare providers like Ramsay are feeling the pain. Its rival, though, being Sonic Healthcare, which focuses on pathology and labs, also noted a softer earnings as COVID testing revenue vanished and cost pressures grew, though Sonic overall held up better. The bottom line was, healthcare, which is usually a defensive sector, looked surprisingly vulnerable, especially where companies had high costs or global operations facing challenges. If we turn to look at the other weak spot, which is resources, and a lifeblood of the ASX, we saw the resources sector overall quite soft. The mining sector didn't have a blockbuster season as commodity prices cooled from their prior highs, and many resource companies delivered lower earnings, but Interestingly, their stock movements actually depended on how they manage expectations as well as shareholder returns. We had BHP, who saw its revenue for the year fall about 8% down to 51 billion, and profits likewise eased. Lower iron ore and metal prices were a major factor. However, BHP somewhat sweetened the pill with dividends. It declared a generous final dividend in line with its policy, but a tad above what was expected, which, as we noted earlier, surprised on the upside. And because of that, BHP's stock actually ticked up about 1.5% on results day, which basically meant that investors are saying, well, okay, growth is slow, but at least we're getting paid for it. And BHP also spoke of confidence in the long-term demand, especially for commodities like copper, which is needed in a lot of renewable projects. And given it has a strong balance sheet, this reassured the market overall. Rio Tinto, in contrast, had less to cheer. In its half-year report, Rio's net profit fell 16 to 22% as iron ore earnings declined and costs rose. The company cut its dividend by about 16%, sticking to a 50% payout of lower profits. Unlike BHP, though, Rio's shareholder return was exactly in line with the weaker profit, so no surprise boost there. The stock market response was tepid to negative, and Rio's shares drifted lower after the announcement. They didn't crash, which is important to note, but the enthusiasm just wasn't there. It doesn't help that Rio also invested heavily in new projects like Simandou iron ore in Guinea, which will take years to pay off. The resources theme broadly was last year's windfalls aren't repeating and miners are moving into a phase of tighter margins. We then had MinRes, or Mineral Resources as its full name, a mid-tier diversified miner that was also worth noting because it encapsulates the challenge that the sector has. MinRes reported a stark result. Its revenue was down 15 and it swung to a net loss of 896 million for FY25. What happened? In short, commodity prices collapsed, especially lithium, one of MinRes's key products. Lithium prices fell almost 90% from their peak, which is a dramatic crash after the EV battery minerals price boom last year. That, plus weaker iron ore prices, hit MinRes's earnings hard. They also took over $600 million in impairments, otherwise known as write-downs on some assets, which pushed the statutory loss into the red. Now, interestingly though, MinRes did highlight some positives. Their new Onslow iron project started producing and their mining services division had record earnings. In fact, underlying EBITDA in mining services was actually up 34% to a record $737 million, a sign that one part of the business was robust. But overall, given the tough market, MinRes's board opted to skip the final dividend to conserve cash. The stock price itself had been weak leading into the result, down nearly 20% over the past year, and on results day it initially tumbled on the 15% revenue decline news. Thereafter, it stabilised as management talked up the future. They're now considering asset sales and refocusing, basically going into hunker-down mode. The MinRes story shows how resource companies are at the mercy of commodity cycles, and when prices fall, even operationally strong firms can see profit evaporate. It also reinforces why investors have been favouring those miners that return cash over those that don't. Beyond these, other resource plays like Woodside Energy had solid profits but faced moderating oil price, and Newcrest, which is a gold miner, actually got acquired by Newmont, so it's a special case. Fortescue Metals had some investor drama about its clean energy strategy, but operationally still a high dividend payout. In general, the resource sector in August 2025 was mixed to weak, a come down from the boom times with an emphasis on discipline and a long-term project investment rather than any form of immediate growth. If we then move on to a sector that is somewhat probably more exciting to many punters out there, is tech and mid-cap. And this was a mixture of winners and losers. The season was a tale of two worlds. Some tech and mid-cap stocks absolutely soared on good or not as bad news, while others were hammered for misses. It really underlines the whole expectation theme that I started with at the beginning of today's podcast. On the winner side, we had IDP Education, which we talked about already. And then we had some selective tech winners like carsales.com, which reported strong revenue growth as car listings stayed high and expanded overseas. Its stock actually climbed on results, continuing a strong year. Another is Xero, the cloud accounting software firm. Although it reports on a different cycle, it had results back in May. Its shares have been buoyed by returning to profit and better operating metrics. It's been a market darling in 2025, so sentiment was positive even during the August wrap-up. Then we had Seek, which is the job ads platform, noted stable demand for labour in its results, which wasn't spectacular, but not that bad either, and their stock held steady as hiring hasn't fallen off a cliff. And outside pure tech, there were some mid-cap industrials that had great wins, like Austal, which is a shipbuilder, which stunned with a huge profit surge. And then things like Harvey Norman also was another mid-cap that surprised. All these underscore that growth is still rewarded by the market if a company managed to grow earnings or even just beat expectations. Investors were willing to pay up, even in a cautious climate. If we then look at the other side of the ledger, which are the losers, or we call selective tech losers, we had WiseTech Global. This is the logistics software company that's been a market darling, but it tripped this season. It actually delivered a 17% increase in net profit to $200 million, slightly beating its own forecast. And it also projected strong revenue and earnings growth for the financial year 26. So you're going to ask, that sounds great, right? The stock actually tanked 14% on the day. Why? Because WiseTech's FY26 guidance, while showing growth of around 80% in revenue, partly due to acquisitions, implied profit margins would shrink down to 40% from nearly 50% last year. Essentially, the market expected even more, and when WiseTech's outlook didn't clear that high bar due to integration of a big acquisition and some accounting changes, the stock was sold off. It was a classic case of a high PE tech stock getting pummeled for guidance below consensus, even though absolute results were good. The episode wiped out a lot of WiseTech's year-to-date gains and reminded everyone that in growth stocks, pricing power and margins are king. Any hint of slippage and investors will bolt. There are other misses, and they were punished, including PEXA Group, which is the property settlement software firm. They posted a loss and guidance that missed the analyst forecast, and its shares dived. We also saw Technology One, which is an enterprise software maker, slightly underwhelming on growth, and we saw its stock cooled off too. James Hardie, which is exposed to the US housing market, gave weaker guidance and its stock plunged over 30% in early August, one of the steepest declines in the season. These reactions show that the market had a zero tolerance for disappointment in growth and cyclical names. So overall, the conclusion and the key takeaways is that 1, consumer-facing sectors showed resilience, especially in discretionary retail and travel. Despite the cost of living pressures, Australians are still spending. They're just choosy about where they find value. So your Wesfarmers, JB Hi-Fi, Harvey Norman, Qantas got the great gains and results, but Woolworths got hit hard. There was cost control and efficiency was another key theme, and we talked about that through CSL or IDP, so on and so forth. We then also saw an important recurrence of shareholder returns, whereby if you got paid to own the risk, investors were quite happy with that. It was about cautious optimism, but if boards were happy to return capital to shareholders through share buybacks or maintain their dividends, they were rewarded handsomely. We then saw healthcare and resources were somewhat weaker compared to other sectors. And the market reaction was all about surprise versus expectations. So as we wrap up this earnings season, the ASX as a whole managed to grind out the gains in August, with the index up around 2 to 3% for the month, marking 5 consecutive months of rises. That wall of worry, the high rates, inflation, Chinese economic concerns, hasn't really derailed the market because corporate Australia showed it can adapt. Investors, though, have rotated a bit, piling into stocks with stable or improving outlooks, such as banks, travel, and selected retailers, and rotating out of those with clouds on the horizon, some of the healthcare names and some of the high-flying tech that lost a bit of altitude. Looking ahead though, the focus will shift on how the rest of 2025 unfolds. Will the RBA's rate cuts, which has been 75 basis points so far, start to really boost consumer sentiment coming into the Christmas season? Will China's stimulus help commodity prices recover, aiding our mining companies? Can companies deliver on the cost cuts and growth guidance they promised, or were they painting too rosy a picture? And of course, for investors, will those fat dividends continue? The next months, and then obviously the next half year of results in early 2026 will begin to answer those questions. But for now, the August 2025 reporting season can be summed up like this. The conditions were overall challenging, fortunes were divergent, and we saw blue chip pain for some previously reliable giants. But also an endless rally for companies that have navigated well, which is making the market very, very interesting. So it's a good reminder as investors to stay diversified and to pay attention not just to the headlines, but to what companies are saying about the road ahead. So I hope you enjoyed our earnings season special coverage. Happy investing, and I look forward to talking with you on the next episode. See ya.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.